Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe with Streamline Capital. Super excited for today's show. We've got none other than Dan French on the line with us today. So Dan, welcome.
Brian, thanks for having me on. I've listened to a bunch of your pods and I'm a big fan. So I'm pumped to be
Appreciate
on.
it. Thanks a lot. Very much appreciate that. So I got to ask the question, we're starting the Olympics in Paris later this week. Are you actually French?
No, I'm not. But if I had a nickel for every time I've been asked that, I'd be doing all right. I wouldn't have to invest anymore. No,
All right.
I'm not actually. I'm Italian and Irish, and
Okay.
actually French is an Irish name, believe it or not. Maybe some Frenchman found his way to Ireland at one point, and they called him French. I don't know how that all went down, but I was in Paris about a month ago with my family, and
Nice.
kind of pumped up to see the Olympics there.
Well, I had a Scottish friend at one point, and we called him Scotty. We thought we were really original with that, but apparently not. So,
yeah.
All right, let's see. Last names and nicknames aside, let's talk about you. Do us a favor. Tell us about, where you're from, who you are, and how you got started into apartment investing.
Yeah, well, I'm from New York. I'm from the Bronx. That's where I was raised, working class family, and so grew up actually upstate a little bit from the time I was 7. My parents moved us out there, and so still suburban New York City metro, but more of a place that you want to raise kids. And in the 80s in New York City, it was not really that great of a place to have your family grow up. So anyway, that was the American dream thing, right? It was like my parents worked really hard to get us out of there and give us a better life, and I'm very grateful for them. But as far as real estate goes, I've been investing and operating real estate for about 20 years. And I got started in 2004 with someone who's still my business partner. His name is Pete Rex. I'm very blessed to have this long duration business partnership. It's been wonderful. Started off investing in small real estate deals, like 2-unit building type deals, 4-unit buildings. Before you knew it, between 04 and 07, we had a portfolio of call it 100 units. And growing up, that was a dream of mine that I had somewhere in my heart was to kind of build future wealth. And real estate became the capacity to do it. During that time, concurrently, I was also pursuing a career in public service. So I became an elected official for 7 years.
Interesting.
In my hometown, unexpectedly. I didn't know I was going to pursue that as I was growing up, but real estate became an engine for me to get to a different level in terms of wealth creation, in terms of future building a wealth for my future family. So let me pause there. And that's how I got started.
Yeah. So, starting out, I think a lot of people contemplate how to start out. You started out with the 2 to 4 units, like the smaller sizes. Well, let me ask this question. Knowing what you know now, would you do anything different with that trajectory? Would you have gone bigger earlier, or, going back to that spot, knowing what you knew now, would you have done the same thing over again?
I wouldn't do the same thing over again in so many different ways. I would still have the same partners. Mm-hmm. So I think I got that right. I have wonderful partners with Pete and his brother, Rob. I grew up with these people. I trusted them, and they had crazy integrity and great character, but we bought in the wrong locations. So, besides whether you should go for 2-unit first, or should you do 20 units, should you go straight to 200 units? Besides all that, we bought in the wrong location. That was not a high growth, dynamic area. It was up in New York in a place that wasn't growing fast, and it wasn't a metro that I would ever, knowing how much I know about real estate now and demographics and economic population growth, I just wouldn't choose that anymore. But in terms of getting started, I do think that this whole mentality of that people want to get into the game and get experience, like maybe house hacking or buying a 2-unit building, I think that is a kind of a cool way to get started, because on the positive side, it forces you to learn everything, full stack. So I really know the operation, in my gut. I know how to, I've seen a lot of stuff go wrong in maintenance. I've seen a lot of stuff go wrong with people I personally have hired to run a building. Yep. I've seen fraud. I've seen theft. I've seen people lying to me to my face about their ability to pay rent. I've had to evict people myself, which is not pleasant. No one wants to do that. But, in your gut somewhere, it becomes, what I get scared of is these people that come at real estate from such a theoretical, Excel spreadsheet mentality. It's like, dude, if you don't know the whole stack of operations, asset management, debt, and then underwriting as well, I think you're going to get in trouble. So that's what I liked about what we did, starting really small.
Yeah, yeah. And you mentioned that, you wouldn't buy the same type of stuff earlier. Now, maybe a leading question, but, did you buy that stuff because it was the easy stuff to get to? Or let's go a little bit more into like why you bought that stuff and why you wouldn't.
Yeah, I think we bought the stuff because it was marketed and we had a target market and it was what we could find. And, it wasn't that big of a market, so there wasn't that much liquidity. And also it was a time when there was a lot of hype, and I fell victim to this too myself. And now I'm a much more experienced investor. I understand irrational exuberance. I understand people that get this FOMO, fear of missing out. And that was me, man. I was like guilty as charged. In 2004, 5, 6, like I describe it to people like I had an infomercial idea of investment. It's like, the infomercial people like, you can't lose, just wait 3 years and you're going to triple your money. Like I sort of had that mentality. So that's why I think we picked the spots. Now, I think what we also did wrong was we picked neighborhoods that weren't as safe as well. And so I spent a lot of time in tough neighborhoods, the kind of place that even during the day, it's a little bit scary, but I'm used to that kind of thing. But like at night, you probably just don't want to be there. Like life is too short. We don't invest in that kind of stuff anymore.
Yeah. And, I made a couple of those mistakes early on as well, buying properties in areas that I wouldn't ever want to live in. And looking back at it, I have the same mentality. It's, we're not buying anything in a crime-ridden area anymore. We're buying stuff in nice neighborhoods and areas especially areas that we think are going to be better 5, 10, or 15 years from now. So yeah, we're a little bit more picky on location, but we can be. So it's nice.
Yeah. Well, being the, inexperienced investor that I was, right, we made some other problematic moves too. Like we had way too much leverage on our deals. So we took as much leverage as we can get our hands on, and we didn't have a lot of capital reserves. And we struggled in our early years to get good property management in place. That's why we did a lot of it ourselves, because we had to keep kicking people off our deals and then going and kind of doing it ourselves. Yeah. So by the Great Financial Crisis, we became kind of like the poster child for, people who were in trouble on their deals really in the beginning part of the crisis, because when people couldn't pay their rents, that's how skinny we were trying to skate by on our dealing with banks and whatnot. So through many years of grit, determination, and just hard work, we worked it out with these different banks. And as you recall, a lot of the banks actually folded. We didn't even know who we were dealing with, because a lot of the banks had sold their had just completely melted, right? Yeah. And so they were bought for pennies on the dollar by different private equity groups or other banks. Yeah. So a lot of that whole deal was just wondering, who do I need? Who's my counterparty?
Who am I sending my payment to this month? Yeah,
exactly. I used to have stacks of mail in my house, and just trying to unpack all of it was a lot of learnings about how the financial industry really works. And we got past all of it, and then we paid back all of our initial investors through future earnings. I didn't make anything on real estate for many, many years, like over a decade for sure, like 15 years probably, before I really made any true money in real estate. So that's another learning for the audience, right? It's like you can shortcut hopefully your journey through real estate by listening to great people like you who are sharing value, sharing your story, getting people on to say, well, do this, don't do that.
Yeah. Yeah. I agree 100%. Now, talk about the hype. I bought my first house in August of 2007, my first investment property, and bought my second one a year later while the market was still sliding. It was closer to the bottom, but I think I agree. It was several years before either one of those properties cash flowed. And normally it was on one property most months I didn't have to pitch in. On the other property, most months I did. So it was kind of like, half and half on it, but crazy. I decided to keep doing it. I kept on seeing the equity build over the time. I saw the equity build and build and build and build. And that's what got me hooked. But so let's fast forward past that one and get into the next stage.
Yeah, the next phase is a lot happier, thank goodness. And I thank God that I stuck with real estate and stuck with my partner, Pete. So basically in 2010, he got out of Harvard Law School. He decided to go down to Florida and to start up a brand new entity. That this is separate from our previous investment partnership vehicle that we had. So this is a vertically integrated real estate investment firm, right? So it did all of its own property and construction management. And that's where the happy part of the story goes in, because between 2011 and 2019, we purchased about $2 billion of total asset value. Focused on Florida and Texas markets. I think we made number one. We picked the right markets, right?
Yeah.
Those two raged back, and in early 2011, Florida was considered a contrarian bet. A lot of people thought it would be a lost decade for Florida, and it was a very tourism-focused economy, or more so than it is today, for sure. And people thought it would just be in a meltdown and kind of a doom spiral. We bet the opposite. We took a contrarian bet there, and it worked out really well.
Yeah.
So that was a lot of fun. I became CEO of that firm in 2016. And we built out a really scaled out operation, like 450 people business. And so let me pause there.
Now, what did you like? I mean, obviously, in retrospect, I mean, Texas and Florida have probably been the two hottest states for real estate. Besides Utah, most people don't look at Utah because the average decent sized city in both those states have more than the entire Utah population. But I mean, what was it about Florida specifically and Texas specifically that you guys liked when you started buying?
A lot of things, really. Well, I would say number one, would be the regulatory environment. We felt was, if you look across the U.S., there's only 9 states with no income tax. That's number one, right? So that's already a place where people, if they're going to move for opportunity, I think they're going to look at places like Florida, like Texas, where they can keep a lot more of their income. And then on top of that, I think we had a very business-friendly environment in both states. And so from a business regulation standpoint, that's going to have massive impact on economic development. And we see that playing out still to this day in both states, right? Yeah. Florida, Miami is becoming the crypto hub, right? It already has been, but it's also become a financial hub, like Citadel's down there. All these major shops from New York bringing trillions of dollars of wealth that they can manage, right? But then also billions of dollars of people that are moving their retirement income down to a place like Florida. Yeah. Texas, same thing, right? You have Elon showing that he wants to invest in a place where, if you want to build a gigafactory here, we'll do it here's your permit. Like
that's just outside of Austin where you live, right?
Yeah, it's fascinating to see. It's amazing. When you go there, even just driving around the gigafactory, it's massive. And they built it in record time. I don't even know what it was, but you can watch aerial footage of it. I did that one time. It's fascinating how quick it goes from idea to execution here in a state like Texas. Wants to push the economy forward versus a place like California that has this red tape ad nauseum. It just makes you sick. No, that was the major ideas was that economic growth will drive population growth. People need a place to live. Let's invest in multifamily and let's do a great job and be the best operator we can be.
Yeah, that's what I'm looking for. Economic jobs, people go to jobs, and where the jobs are, especially the high paying jobs, you're going to have people moving in if there's high paying jobs, and economic growth pushes up population growth, which usually makes a supply and demand, an impact on that supply demand curve, which usually makes real estate prices go up.
Right.
Now, you mentioned that you were buying from 11 to 19, and after 19, you guys were net sellers. Let's talk about that for a little bit. Why did you guys decide to be net sellers, and how did that go for you?
Yeah, it was a major strategic pivot in our firm, and we debated it for quite some time. But over time, when we first got started especially in Florida, it was like crickets. The capital markets were still pretty frozen. And we were sometimes the first new capital buying back into blighted neighborhoods that especially in Florida, had been like really almost left for dead because a lot of people were turning in their keys to the banks. The banks didn't want to manage these things, and they were managing them very poorly. So we bought a couple of our initial deals right from the banks, right? We were buying highly physically distressed deals and adding value that way by bringing them back up to habitability. And then later on, we traded into like this the more traditional value add approach where it's, it's occupied, it's more stable, but you're adding value by renovating the product. Maybe you're boosting around to a couple $100 or whatever it is. So early on, we were kind of like standing out. We did stand out big time because the brokers all knew we can close, we're active, and a lot of groups weren't. So but by 2019, so many firms had rushed into the space, the play that we had been doing for many years already, and they bid up all these opportunities. So supply and demand was crazy, cap rates compressed, and we felt like, you know what, we're not going to reach because we're disciplined investors. If we can't buy, let's just sell, and let's sell into that froth. And so we locked in really great returns for our LPs. We returned a ton of capital plus great returns for people who believed in us and invested with us. So that was the idea. It was like, let's take the chips off the table and let's see what happens with the market. And then COVID happened. Yeah. Then beyond COVID, the pricing got even wilder if
Yeah.
we didn't predict that. But now we're back at it because we see that on the other side of this, with the Fed increasing their rates historically, so fast and so quick, now we think it's a good time to buy. So yeah,
Yeah.
that's
So what percentage, and you may have mentioned this and I missed it, but what percentage of the portfolio did you guys sell in that 2019 timeframe?
we sold like 1.5 billion,
Mhm.
and then since then have sold a handful of deals here and there, 80%, something like
Okay.
that.
Okay.
Yeah, quite a bit, quite a
Yeah.
bit. Yeah, there's a legacy portfolio from the old firm, but now this new firm is the common thread is that Pete Rex is the founder,
Mhm.
executive chairman. I'm
Yep.
still with him in the new firm, and a couple of our older partners have
Mhm.
transitioned to a new firm here.
So looking at where we are in the market right now, I mean, you mentioned with, how fast rates have gone up and prices gone down. You think you mentioned that it's a good time to buy. What are you expecting in the next couple of years as far as market conditions?
I think it's still tough going for owners of assets.
Mhm.
I was talking to someone I really respected. I was having lunch with him, and I think the number is like 1.7 trillion in commercial real estate loans
Yep.
that's coming due, and a subset of that is going to be in duress.
Mhm.
So I do think that no matter what the Fed does, people have put debt at rates that are either it's floating or their debt. It's
Mhm.
based on such a high purchase price
Yeah.
because they reached in 2021, 2022, that sometimes you can buy a deal for less than the debt in
Mhm.
multifamily. That's kind of unheard of. We haven't seen that in a while. So I do think unwinding all of that, it's not going to be a meltdown like 2008, but there's opportunity.
Yeah, I tend to agree. I think, I'm thinking that most people, when you sign up for a loan, you know exactly what the term is. So if you're sitting, 3 years into a 5-year term and you know where you're at, you got time to maneuver. And so I think most of the operators are going to be able to use that maneuver space to make sure that they're not, I mean, they may take a haircut, lose some money here and there, but I don't think it's going to be like the bloodbath a lot of people have been predicting. So.
I agree. Anyone that put fixed debt, I think, has been in good stead. The people that the groups that did floating debt with rate caps, they're in big trouble. And we've already seen some of that unwind, like this group called Tides, right? It's been in the news
Yeah.
quite a bit. Those kind of groups, I think they were doing capital calls and they were trying for a pref equity infusion. And once you get out of options, it's either you sell at a fire sale at a loss or you get foreclosed.
Yep, makes sense. Makes sense. All right. Well, we're been talking for a good 20 minutes or so. What else is on? What haven't we talked about that you think needs to come up?
Yeah, I think I've been thinking a lot about demographics and
Yeah.
where does it go from here, and interested to hear your take too on Salt Lake City, and are people what kind of people are moving there? Is it just tech driven and they're having a good run? How does remote work change where people live?
Yeah.
How does maybe the future of autonomous vehicles,
Mhm.
if that becomes a real thing, how much further out will people go? If they're not as tethered to a city center like
Mhm.
they have been to go into the office and what have you,
Yeah.
the suburban become more interesting. And these BTR people, are they just geniuses because they're further out? I think some of these are really interesting trends.
It's something I noticed, and this was I've lived in some very large cities. I spent some time commuting from a suburb of DC into DC. And it was right about the time that I was starting to invest in real estate. And so I was really paying attention to prices. And I
Mm,
had this epiphany one day. This is before COVID, but it was just like if public transportation, if it were easier and faster to get into that city center, the real estate prices downtown wouldn't be that much more expensive than 30, 40, or 50 miles out. But the
right.
fact is I live 20 miles away from the downtown DC area, and it was taking me over an hour to get there. And so people were paying premiums for that shorter commute. And I think there's a couple of trends there. As like you said, as autonomous vehicles come out, you can literally just sit there and let your car drive. If that ever comes out, I think there is going to be kind of more of a move towards suburbia. But I think like most trends, it's going to be over time. I haven't really thought about it. That's a good point. I think we're seeing some of the same things with post-COVID, the pandemic, and the remote officing. People are able to live a little bit further away. We've seen some cities especially go from people moving from the urban to the suburban. so they could have more space, so they could have more freedom. And they're able to do that because they're only going to the office 2 or 3 days a week instead of 5. So I
Yeah.
think the autonomous vehicles are going to have like the same type of effect. But I mean, good points. Yeah. What are your thoughts on that?
I think similar to yours probably, but and you make really good points about I think that's going to have a dramatic impact on real estate pricing because of the supply and demand. But I do think that what cities can stand out with is like
Mhm.
being an amenity. If
Yeah.
I want to go see a show or go to have a cultural experience, maybe I don't get it in the suburbs. So I
Mhm.
think cities need to like reinvent themselves to be a place where that happens, and also like different collisions happen with people who are like-minded. They want to go into the city center and have
Mhm.
an experience with other people. In real life, like we're still humans. We need to get together in person at some points. So
Yeah.
I think the city can still thrive. But then another good trend I would say is like democratizing real estate investment. That's something I'm really excited about. I'm very bullish on that. We've already seen like from 2012, the Jobs Act made crowdfunding way more easier to do from a regulatory standpoint. And I think getting out of the way of people who are private investors to get into private real estate deals is really good for the average everyday person, because they shouldn't be locked into just stocks or bonds or like their 401k. They should be thinking about their portfolio like a family office does.
Yeah.
A family office has a large amount in public equities,
Mhm.
but they have an allocation for alternatives. And a
Yeah.
big part of alternatives is real estate.
Mhm.
And this is good for people.
Yeah.
So I like to see the continuation of that trend.
Yeah, I think it's definitely more and more people are picking up on it. I mean, some people are using like the tokenization to be able to do
Mhm.
that. But talking with a group out of Salt Lake City that's trying to create a marketplace to sell, your private placement shares here and there. I think that's all good for the industry. I think it makes people more likely to actually invest. If you know there is a way to get out, I think a lot more people would be willing to jump in.
Yeah,
So,
exactly. Exactly. I'm very familiar with that. We have on our real estate technology platform, we launched a company called OwnProp that does that. So it's going to be a very long-term build out on that deal, because having secondary liquidity in real estate is not how people think currently. So it's going to have to be something that people need to be kind of re-educated on. Like, oh wow, I bought my position today for $1,000.
yeah,
Maybe I want to hold it until the sponsor sells it in 5 or 7 years, and maybe I want to sell it in year two and
yeah.
take 1,500. Yeah, I already made 500. I'll take it off the table. So I think real estate's got that's going to happen. Real world assets going on the blockchain, and it's very exciting stuff.
Yeah, it sounds interesting. I think looking at it like anything else, I think it's going to take a little while, but once it catches on, it's just gonna explode. And I'm always optimistic about real estate prices, but when you start looking at this, I think it's going to be similar to what like E-Trade did to the stock market. When regular
Mhm.
people didn't have to pick up the phone and call a broker and say, hey, can you make this trade for me, and pay whatever that brokerage fee was per trade. I think it made it a lot easier for people to invest, which consequently put a lot of money into the market, which made that market really, really tick up. So
That's
it,
smart.
yeah, I
Exactly.
think this has the same possibility to do with real estate because, right now when I do a capital raise, we're looking at $1,000 minimums, which rules out a whole lot of people. If we were able to democratize it and bring a lot more people in, yeah, I'd be getting smaller investment amounts, but I
Yeah.
think the overall amount of money going into these private placements would go up. Anyway, interesting. Well, time to start wrapping things up. And so, next question, what's next for you?
Went by quick, Brian. That means we had fun.
Oh,
What's next for me? Just trying to be. I'm very missionary focused, so I want to
mhm.
do a good job with our investors. I want to serve them really well and align our interests with theirs, and so that way they can sleep better and just enjoy their life. And so I want them, if they trust us with their capital, I want them to have a great experience. I want to find some great deals, keep building out our investor network and relationships. And so that's on the real estate private equity side. And I think I might have mentioned, but we have a property management business that serves anyone who owns residential real estate in Florida, Texas, or South Carolina. So if you have over 100 units, we'd love to speak with you, maybe find out if we can serve you, do a good job for you.
Yeah,
Yeah.
awesome. Awesome. Next question. If you had to give advice to somebody who is just starting out in multifamily, what would that be?
probably goes back a little bit to some of my personal experience, but just I would say like if you're committed to doing something, we'll start. That doesn't mean buying the first deal that comes across your plate. Please don't do that. But I think listening to great people like you, Brian, learning real estate from the ground up, maybe experientially being an LP in deals or property managing or whatever, like something that's going to really make it real to you. So you have an education side and then you have like an experiential side and just get started today, whatever it is.
Yeah.
And then before you know it, a lot of things are going to go into your thinking. You're going to figure out things in your gut.
Before you know it, you're going to be sitting on billions of dollars of assets, right?
Yeah, something like that. Yeah.
Yeah. So that's my goal. I haven't gotten there yet, but eventually. All right. And last question: how can listeners learn more about you?
I'm very active on LinkedIn. I'm trying to add value to people there. So check me out, Daniel French. It's on LinkedIn. And my personal cell phone number is 845-629-1808. Some people think I'm crazy for giving it out, but it's always been out there, and I love to hit up. I love to be hit up by people, so reach out.
I have actually cold called a couple of people who gave their phone numbers out on podcasts and never had a negative experience. So
Cool.
Anyway, yeah, I think if you're willing to take random calls, that's worth putting that out there. So.
Yeah.
All right. We'll put your LinkedIn profile, a link to the LinkedIn profile in the show notes along with the phone number. So anybody who's listening can just reach out in the show notes and grab it. So, well, Dan, thanks for coming on today. Very much appreciate your time.
Thanks for having me on.